Together we have over a decade of experience in real estate investing. We've flipped dozens of homes, and we've assembled a multi-million-dollar rental portfolio spanning the country.
We started real estate investing so that we could create generational wealth for our families and for our children's families.
We started this channel to showcase our successes and our failures, and inspire you to go out and do real estate yourself. We just bought a house with a 4-car garage and a ugly layout. We're going to flip this thing, and we're going to turn it into a masterpiece. And we're going to take you along with the adventure.
My first real estate transaction was freaking amazing. I started cash flowing $8,000 a month until something happened. And I started losing $4,200 a month.
So what I want you to do is turn to whomever is sitting next to you and just apologize for all the brain matter that's going to splatter all over the place, because we're going to blow your mind. It's going to be awesome.
I've been a real estate investor for over 5 years. And I have flipped dozens and dozens of homes. What I found is that design is everything.
Real estate investing has been an incredible journey for us, and we're excited to take you along for the ride. What's up? What's up? We are live, and we're going to be chatting about some awesome stuff with you guys today. We have a guest speaker with us that's going to be sharing some incredible stuff, so you guys are in for a treat. But I do want to share with you some of our announcements today. Before we dive too far into what we have planned for you today, there are a few announcements I want to share. So first off, I wanted to share what we've been doing on the YouTube channel. You guys got to see the trailer as it popped up there. So on the YouTube channel, we have dropped a couple of videos in the last couple of days, and I want you guys to be able to check those out. So we're continuing down our rentals track, right? We've released several videos up till now where I think we're on part 11 that we just released today. So in the last week, we've released videos on how to find good tenants and how to screen for your tenants. We've released a video on how on what landlord mistakes to avoid. That's part 10. And part 11, which just dropped yesterday, is rental agreement essentials. So it's important to know what to put into your rental agreement. You're going to want to know that. You're going to want to check out the video. It's on our YouTube channel, Flipping with Mitch and Maeli. You guys are going to want to check that out. Make sure you subscribe and ring the bell, because there's a lot of good stuff that we drop every other day. Now, in the light of announcements, we are also going to be talking about some of the things that are coming up that are going to be live events. So we have live events every Tuesday at 1 p.m. We have live events every Tuesday at 7 p.m. Live events every Thursday at 7 p.m. And these are all in the Salt Lake City area. If you are outside of Salt Lake, which I know we have a nationwide audience, feel free to reach out to me. We have real estate investor groups around the country, and you're going to want to join these things because they are incredible. You get to meet like-minded individuals who can help you with deals. You can partner up with, just absolutely an incredible value to be plugged into a community of real estate investors. So reach out to me if you have any questions about that. And then we have our all-in event coming up. Mark Kohler is going to be joining us. Mark is a stud, and he has a YouTube channel that has just exploded recently. He releases some incredible content, and you know what? He takes a very boring topic. He takes the boring topic of taxes and legal structure in business, and he makes it fun. Honestly, I am so entertained when I listen to Mark. He's the instructor of 16 hours worth of education inside of our classes on tax and legal. He's going to be in Idaho Falls live from what is it, Maeli? Next Friday and Saturday. So that's going to be the 17th and the 18th. You're going to want to be there. There are some requirements that you're going to need to fulfill in order to be there. But come check it out. So reach out to us if you have any questions on that. You're going to want to be a part of it. So with that said, I have the distinct privilege of welcoming our special guest today, Carrie Mann. Carrie has some extensive experience in mortgages, And I wanted to bring her on. You know, when we started talking about real estate investing, we started bouncing some ideas off of each other. And this person is a wealth of knowledge when it comes to understanding mortgages. And you know what? As real estate investors, whether we are going out and buying properties traditionally and getting a traditional mortgage on them, or if we're going to get a commercial loan, or if we're going to take over someone else's mortgage in like a subject to or seller finance type scenario, it is important that we understand how mortgages work. And I can't think of anybody better to share that with us than Carrie Mann. Carrie, you're on mute, but go ahead and come off mute and grace us with your knowledge here. Welcome to the call.
Thanks. Just to preface at the very beginning, my voice is having some trouble, so getting over a cold, but I want to thank you both, Mitch and Maeli. You've changed my world. I have really enjoyed getting to know you and all of the things that you've provided. You're both just full of knowledge, and that's why I gravitate towards you both. And thank you for the opportunity to share. I love sharing. I love teaching. It's one of my favorite things to do. So happy to be here.
We're happy to have you here. Thank you. That's very kind of you.
Yeah. So fire away. What questions do you have? And I'm ready to go.
Yeah, Maeli, I think you had the first questions prepared.
I do. Yeah. So let's look at what we had some questions come up on our Instagram. So earlier today I posted like, what questions do you have around mortgage? Do you know what a mortgage is? I mean, it's funny how, right? I mean, it is actually interesting if you, and I'm sure you run into this all the time, like, what's a mortgage? Like, oh, I have to buy a house, and what do I buy it with? Oh, it's called a mortgage. That's weird. Most people buy, a mortgage or a house with a mortgage. Now, not everyone does, right? We teach obviously creative financing, but I do think that's a funny attribute. What's a mortgage? So definitely, I think probably starting out with just as simple as a blanket statement. What's the difference between, we talked about this actually a couple weeks ago. What's the difference between if you go to a traditional like Zions Bank or, Wells Fargo or any of the really big companies, if you're like, hey, I need, Mountain America, like I need a loan. That's what most people do because that's where they bank, right? I need to buy a house, give me a house loan. Like, tell me the difference of why they would go to a broker or someone like you versus just going to their traditional mortgage company.
Great. I absolutely love this question. So there are actually 4 different types of loan officers out there and 4 different kinds of ways that you can go to a bank of sorts to get money. So she's saying credit union and bank. I just kind of categorize those as one. And those loan officers are not licensed. They work banker hours. So most people need help after 5 p.m. And so now they like to draw people in because they save great interest rates. They typically don't do a bait and switch, but bait and switch meaning like reel you in with this great interest rate and then tell you, oh, wait, it's way higher actually. So they're usually pretty good about keeping their interest rates good, but they tend to have issues on closing the loan and getting the deal done. And it's because they don't have as much motivation. Like they're not commission, they're salary. And so they're not going to work after hours to try to get things done and figured out. And I swear 95% of my work is after regular business hours. So yeah. And then next there's the retail / correspondent lender, and they are direct lenders. And so they basically have one package that they're set up for Fannie and Freddie. That's their conventional loan. Now they do what we call non-QM or non-qualified mortgages, which are outside or called portfolio loans. So that's not governed by Fannie or Freddie. And so basically they have the one shot at getting your loan into underwriting and out and successful. And they typically have higher interest rates than the banks and the credit unions and the brokers, which is what I am, so I'm a broker. And let's see here, then there's me, the broker. And what I do, I'm like an insurance company, and that is like a, instead of going directly to Allstate to go and get your insurance, you'll go to a broker that shops for you, going to Allstate, Geico, and all of those places, right? And then that's what I get to do. I get to go shop at all the different lenders. So those lenders are vying for my attention and they want me to choose them. So they're doing so much extra work. And they're also having to come in with better rates and better opportunities and programs and little, like all these exciting things that I can help my clients with. And so, and I've been in both worlds. I was a correspondent lender, and I am now a broker. And so I've been able to see both sides of the fence, and I'll never look back. I absolutely love the broker world. I feel like I have so much more choice and options. And one of the best options that I've loved, and I've used this several times, is when I have a client that, let's say, okay, this is a story, for example. So they found a house that's a VA loan, a government loan, and they found meth and asbestos inside the house. And they had to remediate all of this stuff. And that took extra time. So as that was happening, it pushed the clock back and made it so that we lock in interest rates at certain days. You know, we get 30 days to lock in a rate, let's say. And they were getting really close to the end of that clock and having to like renegotiate the times that they were going to close. Well, in that, instead of paying all this extra money to relock their interest rate, what we did is we took that and just shifted it over to another company. And we said, here, the interest rates got better. So we ended up saving our clients $50 extra. They didn't have to pay for all these extensions on the locks. And so that's one example that a broker has an option. Like if the interest rate changes and I feel like we have enough time, I can go with a different lender. It's got a better rate.
Yeah, or something that would fit them a little bit better, right? I mean, there's options. I do know that there was a scenario with one of my clients that, you know, same thing where it's like, oh my gosh, we're down to the wire, and all of a sudden they're like, well, we have to switch this to FHA. Wait, what? How do you know what I mean? Like if you're stuck with just a traditional bank, right? Like you're not going anywhere. It's denied at that point in time. Or if the interest rate changes and they didn't get locked for any reason, bam, they're done. Like there's no more, sorry, you're not qualified any longer. That sucks.
Yeah.
Right? So
you're under a slippery slope of your earnest money can go hard and you can lose all of your earnest money. You can lose the house. What if you really wanted the house? I mean, we wrap our emotions up into buying a house. Like it's a really important thing. So why take your chance on somebody who is not going to work after hours for you, who doesn't really dive into knowing exactly what to do to get it done, and doesn't have options, you know, like stuck in one place. And then also interest rates. Like there's, of course, somebody out there is going to beat me on the interest rate. It happens. But if what you're looking for is the cheapest interest rate, you get what you pay for. So, you know, there is that part of it too. Yeah.
Like, yeah. No, back out, right? I didn't want that.
Yeah.
Okay. Why do people shop around? Can you get multiple, like, can they come to you and to other people and get quotes and things? Like, how does that work?
Absolutely. I do encourage getting 3 quotes, especially as investors. You should absolutely get at least 3 quotes. You can lock your rate at all 3 lenders, but here's how I would play the game. I would lock your interest rate at, say, your not quite as sure lender that you're working with. If you feel like the rate's great for the day, lock in, and then check it in a few days with the other lenders that you've been working with and say, hey, has the rate changed? Are we looking at a better rate? And then they can lock in days later. You know, like we like to lock in, of course, once you've picked the property and you have been accepted. There are ways that you can lock prior to that, but it does cost money to do that. So waiting for your contract to be accepted. And then, play the field. Like you can lock at a different lender at a different day and then say, hey, okay, we're going to go forward with that other lender now after all, you know, like now I have the rate that I like. Because you never know. I mean, the market shifts daily. It shifts hourly even. Most people don't realize that one of my first loans that I ever did, I quoted a certain rate, and then 2 hours later before I locked the loan, because I was like, I don't know what to do to lock a loan, blah, you know. And then all of a sudden 2 hours later, oh my gosh, it changed, and it was like $1,500 difference and it cost more, and I was like panicked. I'm like, oh great, I'm gonna have to pay $1,500. This is not cool. Anyway, my lending manager, he's a dreamboat, and he figured it out and he saved the day. But I digress.
But right, I mean that's important. That right, like every hour counts
Yeah,
when you're on the line. Yeah, for
yeah,
sure.
for sure.
So if I get this question a lot, I will get to more of our Instagram questions, but I get this question a lot. What the heck what is a conventional loan versus a FHA loan? Like everyone's always like, well, it's always cheaper to go FHA. Like that's all they think. They're like, oh yeah, it's just cheaper to go FHA. But why would you not? What would be the reason to not use FHA? And what are the scenarios on why you shouldn't use FHA? Like, can you give me some compare and contrast here?
Absolutely. Yeah, so there's actually a big difference. Conventional is, we say Fannie Freddie, and that means that it's a government entity that's watching over us. I like to say it just they're not actually funding the loans or anything, but they're saying, well, actually do get sold to the secondary market. So sorry, yeah, I was stand corrected on my own. But anyway, FHA is insuring the loan. And so it's like, that's the government that's saying, I am going to help out this person and making sure that if they default on the loan, I'm going to help cover that. So the lenders feel a little more secure with those. But FHA loans are typically great for people with lower credit scores below 700. They're better for people with lower down payments. It requires a 3.5% down payment across the board for everybody. And so people like that option, whereas conventional is typically 5%, especially if you're not a first-time home buyer. Conventional, a first-time home buyer can pay 3% in certain circumstances. So conventional sometimes is even better than FHA on that. But FHA has higher mortgage insurance, and they also have an upfront mortgage insurance cost that gets tacked onto the back end of the loan. And that mortgage insurance, if you guys don't know what that is, that's an extra cost to you that benefits you like nothing. It does not benefit you at all. All it does is ensures the lender that if you default on the loan, that they have some sort of insurance policy in place. Okay. So FHA, if you don't put 10% down, they will, they're going to keep that mortgage insurance on for the life of the loan. If you do put 10% down, it'll stay on still for 11 years. Whereas conventional mortgage, it drops off after you have 20% equity in the home. Okay. Now, conventional, yes, their rates are higher. FHA rates are typically a little lower, but mortgage insurance rates on FHA are higher, whereas conventional mortgage insurance is a lot more competitive. And I personally have a lender that's very competitive on mortgage insurance rates, more competitive than most people in the industry. So I got really lucky as a broker that I have the ability to really bring down that mortgage insurance with one particular lender. So yeah, so those are some of the differences.
Right, mortgage insurance. Why do we have to have that? Now, what if you refinanced a FHA loan and you had equity? Can you like get rid of that mortgage insurance ever, or is that just like you're stuck with it?
Well, again, it's that 10%. So actually that's a great question. I need to research that one all the way, but I don't think so. I think it still hangs on there. FHA loans are always designed to actually refinance out of. Oops, sorry, I don't mean to knock the camera. You basically, I always instruct that, hey, like, if I put you in an FHA, I really want to take you out of it as soon as the interest rates drop, because that mortgage insurance is going to cost you, and it goes to nothing, you know. So it's just not the best loan. It's a beginner loan. It's for somebody who, again, like their interest rate or their credit score is a little lower and they have less money to put down. Okay.
Okay. So conventional, if you're going to go buy a second house or a third or fourth as a real estate portfolio type thing, it is going to be conventional. End of story. Correct?
Actually, no. What you can do is if you're buying an investment property, you're wanting to step into that arena, you can use an FHA and a VA in the sense that you can buy a 2 to 4 unit property, you have to live in it though. So FHA and VA, you have to live in it, but the other rentals are, of course, your investment. And then, or you could buy a primary home and live in it for 1 year and then move out and rent it. And now it becomes an investment property. So those are really great ways, actually amazing stepping stones for investors to get in, because you're coming in at the lowest interest rate that you can get, which is FHA and VA. And USDA is actually also very incredible if you don't want to be here in the Salt Lake Valley, like if you want to live out in the boonies or something. Okay, so they just offer some really incredible options to get your feet in the door. But again, you have to wait a year or you have to live in one of the units.
So it's 1 year as an investor. If you're like, hey, I'm going to buy this fourplex, which I love that they made that rule, because as soon as you hit 5, it's bam, multifamily, like, disqualifies everything. It's a whole nother ball game, right? But 4, like, that's so amazing. There's so many opportunities with that. I know we've sold a couple of fourplexes. We purchased them, sold them, and it's fun because you can actually pull comps off of homes that are that entire square footage. I mean, there's all sorts of weird things you can kind of manipulate with the fourplexes, and you can actually still calculate cap, right? Like, that's interesting too, because wait, it's a single family, but nope, you can still, there's a lot of wiggle room there. So I love that. And we actually do have quite a few students who do move into like a duplex or like 2 or a triplex that are like townhomes, or right, for their first investment. I absolutely applaud all of you who are going to do that, because
house hacking.
Or get your like my daughter, she's 14, she goes, so mom, can I buy a she's already, because if I buy a fourplex and I live in the one and I can rent out the others to all my other like student friends, right? And I'm like, of course you're gonna say that. I'm like, yes, that's awesome. Why would you not do that? Or buy a house and then do the same thing, right? But so I do love that scenario. But speaking of the buy the house and then rent out rooms, do you guys have rules around qualifying people for loans? Meaning, like, so I have a house and it's cash flowing, let's say, right? It's a rental. Can you use that rental? What are your, usually how much of that rental income can you take as income to offset so you can go buy another house? Like, can you kind of wrap around like how that works a little bit?
Yeah, that's a great question, because a lot of people want to know that one. So here's the rule. You can take rental income the first year, and we can take 75% of that and count that towards your debt to income ratio. That will help you qualify. Okay, right? Yeah, like, okay. Yes. But here's the catch. Once you put your taxes in to the government, to the IRS, and you say, hey, look at me, I've got a rental and I wrote everything off on it, and it no longer looks like it cash flows or makes any money, now it's going to count against you and against your DTI. Okay, so that's one of those things that when you're going to continually invest, you want to check with your CPA and your loan officer, lender, to make sure that you are doing what you want to help you move forward with, your debt to income. But there are other loans that we don't need your debt to income ratio. Okay, so and that's what usually investors end up going to. They can start in the conventional FHA, VA arena to get their foot in the door because they want that lower interest rate and they can qualify there. But usually, like, how many can you really qualify for in that arena? Like, you really have to like pick up your income in order to support all of that, because, each house you're adding 25% more debt each year after year, right? At least that. And so your income has to kind of match that on the other side in order to keep qualifying. You can qualify for up to 10 on a conventional mortgage with Fannie Freddie. You can have 10, but the other loans that I'll talk here later, like you can do up to 20. I have an all-in-one loan that you can do 3, but the all-in-one loan is really an incredible loan. So we'll talk about that in a little.
Yeah, we're gonna say the best for last, because that's amazing.
If you have questions, do we have to just save them for the end?
The all-in-one.
Yeah, no, I said if we have questions, do we wait to the end, or no, we just leave it in the chat?
Oh, yeah, you can put it in the chat, or Tracy, why don't you ask? Why don't you ask a question? You're
Oh,
good.
no, I just want, carry on, okay? I'll put it in the,
Okay. We'll have a break in just a second. But yeah, so yeah, tell us a little bit more about that.
Oh, wait.
Did you finish your sentence, sir? I didn't know if we could cut you off or not.
Oh, I think I finished.
Okay, good. I was like, oh, okay.
My brain's clear now, so we're good.
Okay,
On to
you're
the
like,
next one.
yeah,
Well, let's let
this is
Tracy
fun.
ask her question then. Tracy, come off mute. Ask your question.
Go ahead.
all right. So, and my dogs bark, see, they have questions.
I answer
So
those.
can you consolidate, people's properties into one loan?
Consolidation loan.
Well,
Like
That's
a
a
blanket,
great
like a
question.
blanket
In
mortgage
different
or a
states,
portfolio
like
mortgage.
Florida, oh my gosh, I can't even think of it. Myrtle Beach and New York.
well,
So my financial partner, we're trying to do some different things, but you mentioned up to 3 properties, and so I thought it kind of clued me into it to
Myrtle
ask the
Beach
question.
is South Carolina, right?
yeah, you can have 3 different mortgages, but I don't think you can have 3 different addresses on one mortgage. So I think you still have to keep your mortgages separate on the conventional side. Now the all-in-one side is a HELOC, and when you have access to a HELOC, as long as your credit line is big enough to support all those properties, you can spend whatever, however, you know.
So I guess if this person had both 2 of the homes that were paid off completely, then do a HELOC on that. Is that what you're saying?
We'll dive into that a little bit.
Okay.
Because we're
All
going to
right.
go on one another.
All right, I knew
Yes.
my question was some everyone. I gotta go now. I'm gonna put myself on mute.
You're great. Yeah.
Thanks for participating, Tracy. You're so great. Okay, so if they come and they say, okay, I'm going to get an FHA loan, you're gonna be like, okay, well, that's great, you know, because you're a first-time home buyer, or maybe things are tight right now, and so it makes sense for whatever your situation is. And then eventually you're going to refinance them out. Now, that is obviously a fantastic way to segue to doing an all-inclusive rather than just a traditional refinance. But before we get into that, because, you know, that's amazing, but that's what we teach all of our students, because that's total leverage at that point in time. Sky's the limit. But let's say you have, I buy most of my houses, we buy, you know, all of our houses, and a lot of the people on here, we buy them with, you know, about 3/4 of the money that we're purchasing the properties with is going to be a hard money loan, right? And then we're partnering up with obviously other local investors who are on this call, a lot of them, right? And so that's super fun. What happens, because here comes the market where we are refinancing almost all of them out, right? And turning them into traditional long-term rentals. What's that process look like? I think that a lot of people are confused because from my understanding, it's a lot easier to do that. But I'm curious if you can kind of maybe expound upon why that's the case. Like, why is it easier than just going to get a traditional loan right from the get-go? Do you know that answer?
Okay, hard money is really great for fix and flip type properties, and they are technically a little bit more money on closing costs and things like that when you're working with a hard money lender, right, Maeli? And I don't do hard money loans, of course, so I don't know exactly that, but
They
but they're
average
meant
about
to
2
only hang
points
on-
at closing. About 2 points at closing, and 12% interest is what I've seen on average.
Okay.
Yeah.
Yeah, there you go. So actually a little less than us. We're usually around closing there, but a little more. We're meant to hang on to those for 2 to 5 months, right? These hard money lenders don't want to have their investment property or their investments go out for even more than a year, and so they're gonna increase their cost exponentially if you try to hang on to a loan with them, because they want to take that money and use it for somebody else really fast. They want to keep turning it over.
So
okay, so
my question was though, so sorry, and yes to all of those. Great answer to the hard money side, but sorry. So if I have already, right? So I already have the hard money loan. It's already in place. Most of these people on the call already have something like that maybe, or they're going to soon, right? There's some newbies on here, which is fun. They're going to have this soon. Well, okay, I have the property. It's already in my name. It's already, it's been 4 months. It's fully rehabbed. what's the process from me if I already have this property, if I'm refinancing it out of a traditional hard money loan and into a traditional loan, what would be that process? I hear it's a lot easier, but do you know why?
You hear it's easier.
Yeah.
Gosh.
Well,
You should tell me.
You should expand, maybe.
Yeah, I'll give you a little bit of an example of something that we just did, and I think I know where Maeli's going with this. So, basically, we can what I've realized in this process is we can rate and term refinance hard money. They treat it like a mortgage, right? And we can just do like a rate and term refinance, which makes it easier than, for example, trying to get a new loan or trying to pull money out potentially.
Okay, my brain just lit up again. Okay,
Yeah, no,
what were you going now to?
What does that mean? What's rate and term? Expound, Carrie. I knew you would know. I just thought, have Mitch trigger you for a second.
Thank you. Yes. Okay, so a rate and term means we're just gonna change either the length of the amount of how long you're gonna hold the loan, which is usually 30 years, but we can change it to 28 or 20 or whatever. So that's changing the term. And then the rate, of course, is the interest rate. So hopefully we're going to like drop the amount of interest that you're paying. Hopefully you're going to take on a cheaper interest rate. And so that's what that means. Now, the benefit of doing that is you're going to skip out on your closing costs are going to get added to the back end of the loan. So you actually don't have to come up with any money up front for a down payment or for closing costs. So that's a huge benefit. That's what Maeli wanted, right?
Yeah.
Okay, there you go. Yeah, so yes, you do have closing costs. They're involved for sure, but they're going to hang out at the back end of the loan, so you're going to pay them later, okay?
Yes, but really, like, that's like yay, because if you're already in a fix and flip or you're already in a remodel and you're dumping all this money into it, and then you got it because you already paid the fees up front, for hard money and all that fun stuff. So I do love that that's an option for all of us to be like, oh yeah, well, I have this asset and I've already paid a ton of fees, so let's just tack those onto the back end, get a cheaper rate, get those in, bada bing, bada boom, right? Like it's traditionally a lot easier overall. So I love that. That's fantastic, and all of us should be thinking about that. Mm-hmm.
I have a little trick. This is not a very well-known trick, and I don't know if you two have been able to use this yet, but I've done this a couple of times, and I love this trick. So usually it happens with people that that you're purchasing their home. So I did it for people. In this example, it was a dad who bought the house for his children because his children couldn't qualify, so he bought the house, and they let his kids live in it and pay rent. And then 10 years go by, and the kids are like, "Well, I think I can go ahead and buy the house from Dad now." So they went down the regular route. They tried to qualify for a conventional loan, but they didn't have any money. They were broke. Their credit score kind of sucked, and they just had a really hard time qualifying. And they were like, oh, "We don't want to pay closing costs, all that shenanigans. We just don't have any money, but we want to buy this house. The interest rates are great." So here's what we did. It was really cool how to structure this. So we made the dad the lender for just a second, and so he became the lender. And then we let the kids just do a refinance with the dad. So they didn't have to come in with closing costs or any down payment or anything. And it saved the day, it saved their bacon, and they got their house. And so if you have a seller that is willing to become the lender for just half a second, you could just refinance the property right then. You don't even have to do seller financing for that long. I mean, seller financing is like this.
Yeah.
As long as you can qualify for that rate and term.
Like a 30-day balloon.
Yeah. Exactly. Yeah. Exactly. That's exactly what it is. Yeah.
Brilliant. I hadn't even thought of that, actually. That's very brilliant, because it's going to be a lot easier to negotiate having somebody do that and coming from the space of, hey, let's get this transaction done. Here's how I need to do it. You're going to seller finance this property to me for 30 days, and the money's due in 30 days. 30-day balloon. Let's get this done. And then in the meantime, after I sign that contract with them, I'm coming to you, and we're getting the loan done in 30, 40 days, whatever amount of time we gave ourselves. And that's awesome. I totally get it.
Yeah, and most lenders think it takes 12 months to do a rate and term, because that's what it is. Like if you go and get a loan yourself, a conventional mortgage, they don't want you to refinance until at least 6 months afterwards, or 12 months. Sometimes it'll say in the paperwork, depending on who you go through. Right. So that's what sticks in their head. And they're like, oh, you can't do rate and term. Like, but when you do it this way, yes, you can do it that fast.
Okay.
I can't even how excited I am with this. So hold on. I need to like figure this out a little bit. Okay. Yeah.
So,
okay. So if you have well, so I do a lot of seller finance deals. I think hopefully a lot of us do on this call. So because we do a lot of seller finance deals, or maybe they want to do, there's a lot of different scenarios you can offer people, but I don't want to pay closing costs. I don't want to do any of those things. Truthfully, like that's a huge negotiating tool for me. That cuts a lot of cost out for raising capital and, all that stuff to close on these deals. So what? That's freaking awesome. And really all I have to convince them is to seller finance it to me for a month or 10 days or whatever.
Yeah. And we have a title company that knows exactly what to do and how to write it on the paperwork. Now, the caveat, though, is there's got to be some equity in there, or you do have to bring in some money for the equity. So I do have to preface that. Okay. So
what's the maximum LTV that you've seen in this market?
Wait, say that again.
What's the maximum LTV that you've seen in this market?
I think it's probably 80 LTV to do that rate and term, or the rate and term.
So you need 20% equity.
I definitely need to talk to you.
Yeah. Yeah. I bet a lot of people do right now. Like, wait, what?
Yeah. I do need to double check that, because the two transactions that I did do recently, they had more equity than that. So if you come in with like 65, 60 LTV, whatever, then yeah, for sure it's easy to do. So, but I think it's up to 80, but I'll double check.
Yeah, please do. That's amazing. And definitely before, Carrie leaves, she's going to be putting all of her contact information in the chat so that everyone can, have that information in the YouTube video once it's live right now. So that's great. But this will be up forever, right? This is going to be live on our YouTube channel. So you can always come back and listen to this. Or if you know somebody that's like, oh my gosh, they need this information, they need to talk to Carrie, right? You can definitely send this video over so she can, they can have a little bit better understanding of what the heck she's talking about before she has a phone call with them maybe. And then we'll put her links and all that fun stuff in the description in our YouTube channel. So once it goes live, usually it goes live within about 24 hours or so.
Actually, it's live immediately. The way that we're doing it, the video is replayable immediately after we end.
There you go. So that's exciting.
So Kathy McKenzie has a question.
Oh, please.
Yeah, Kathy, come on out. Ask your question.
Yeah, I'm a bit confused when you're talking about how the father became the lender for a minute. Was the house completely paid for? Because it has to be completely paid for if he's going to do seller financing, correct or not? I don't understand that. How did they pay off the mortgage in order for him to be the seller?
Because we quickly paid off the mortgage for him. So because in that short amount of time, he's still paying the mortgage that he owed the balance on while we were doing our negotiations. So it didn't really, our refinance still paid off his old mortgage.
So you refinanced him, but then he turned around at the same.
No, I did not refinance the dad. So the dad can become a lender and still have the other mortgage. So he can do that. That's fine.
So
and then
let me help with that explanation a little bit.
And he had to pay off that mortgage.
Okay,
sorry,
so you did like a subject to?
Yes, that's exactly it.
Okay,
Yep.
because I've actually purchased 2 homes this way. What I did was I went in and I did all-inclusive trust deed. I got on title, and then 6 months later refinanced it into my name, and I never had to pay all those fees. Another option is if you can add a child to the deed, put them on the deed, and then have proof, and you'll have to collect copies of the front and back of the check and everything, prove that they actually made the payments, and then they can refinance it as well. That would be another thing. I used to be a mortgage broker, so and you're right about the 20% equity. You need to have 20% equity in order to do a rate and term. Otherwise, you're going to end up with either an 85 or an 80-15 or an 80-10-10. I mean, whatever. you'll have a second mortgage on there, and you'll have mortgage insurance. And then on the FHA, you can get rid of the MIP if you have 20% equity. And that's the only time you can get rid of it. And you also, if you refinance before you have that 20% equity, you will get reimbursed on your MIP for the long-term portion of it. You'll get reimbursed for the years remaining because you had to pay that up front.
Oh, there you go. Look at Kathy, full of information always. Thank you very much. Thank you.
Yeah, we're all in this together.
Absolutely. That's
There's
right.
a lot to know and a lot to learn. So thank you for your insight.
And then Tracy has a question. What states do you serve?
Idaho as well as Utah.
Okay. Very cool.
Perfect. And I'm sure you have a lot of referrals outside of, right, that you could also hook up.
I do have a person who could do all states that I do like and trust. So if you need something outside of all states, I have a referral. Yes.
Brilliant. I knew you would. And that's key. And that's why we do this, right? So we come together as a team and we come together on this call so that we can share, just certain insights. And, we've had some of you other people on this call, right, that are also been a host. But the key is to share your specialties, right? Share your experiences to spark some ideas for other people so they can get excited about it. But also so that we can team up and help each other across the nation, because that is really exciting. That's why we do the YouTube thing, so that everyone from anywhere in the world really can chime in and have some input, and we can be collaborative on these. Okay, so I'm going to look at some more questions. Anybody else have questions while I'm looking
actually, I think with where we're at time-wise, I have a question, and I think it's going to be a long answer. And then I think you should get into how we can partner with you and use the products that you provide in order to go out and do the velocity banking strategy that we've all learned right here. So let's ask the question first, and then I'm going to have you segue into that. And then any wrap-up information that you want to share with us, and then let's open it up for questions and answers. What do you think?
Yeah, that's great.
Okay, so a really popular strategy that people are loving right now is short-term rentals, which is like Airbnb, VRBO, that type of stuff. And a lot of times it's hard to get it's hard to get financing if that's your exit strategy, right? If that's your performance strategy. So we've had to do things like, leasing to a third party and then operate and compensating obviously that third party somehow, and then operating the Airbnb underneath that lease, right? So that we can get the financing in place for it to happen. Do you have products like, let's say, DSCR loans or anything that would qualify us directly for SCRs? And if not, long-term rentals that we could do what we want with after you're done with your thing.
Yeah, great. So yes, the DSCR loan. My throat's getting a little dry. 1 second. And I just ran out of water. Oh no.
Oh no. You can take a second if you need to.
Okay.
Yeah, Tracy.
Yeah. Okay. Thank you, Hannah. Okay. Okay. So we do have a DSCR loan. It's a portfolio loan, so it's not Fannie Freddie, and the qualifications for that are a lot easier because it's just based off of cash flow of the property. So Airbnbs do count. You can even do condo hotels. I don't know if you guys are into those. So those are typically, like, the cons are they're a little higher in their interest rate. Let's see here. I actually wrote it out for me and all of you. 1 second, let me just pull up my pros and cons. Where did it go? All right, so you can be a first-time investor, but you cannot be a first-time homeowner. So there is a difference on that DSCR loan. And first-time investors, they need to have a little bit of a higher credit score, and their limits are a little limited too, because they're like, oh, we don't want to get in too deep with a brand new person, right? Sure. So you can do up to 20 finance properties with DSCR loans. And let's see here. Credit score does count though, so don't think you're off the hook on that one. Okay, so credit score counts. They can do up to 40-year amortizations. Now, the trick with these loans is that here in Utah, it's very hard to get your property to cash flow with a normal loan or even a DSCR loan that, you know, has that higher interest rate if you're just going to do principal and interest payments. But if you do, like, if you're okay with this and want and comfortable doing an interest only, then you can usually show that there's cash flow. Good job, Maeli. Yeah. Okay, and that's how this loan is more powerful. And then we're usually able to get people to approve for that. And you can allow some seller concessions. You can get up to 2% seller concessions. And if you guys don't know what seller concessions are, it just means that the seller is contributing to some of those closing costs and things like that, okay? So with those, you definitely do not want to have any zero, or you don't want to have any late payments on any of your properties. And let's see here. They also need a 1007, basically, and also a rent comparable, the 1007 that is what the appraiser puts together on what the rent value is, and then also a recent lease agreement. And then we look at both of them and figure out where the rent is to try to get your cash flow put together. Okay, so that's the DSCR. But then Mitch, the one that I'm really excited about that we were gonna hold off to the end, it's called the all-in-one offset loan.
We're here, it's almost the end.
Right, so we better get on it. We better get to it, right?
Yes.
There are a ton of pros to this loan. There are some cons to the loan. So if you have not heard about this loan, it's a loan that's more heavily prevalent in Australia, New Zealand, Canada, I believe, also has a style of loan. They do that more than our traditional conventional loans that we do here in America. And what it is, it's a first lien HELOC. And it's designed to, of course, let the flow of cash go in and out. So it takes the power of your entire paycheck and it wants you to throw your entire paycheck at the loan. And it sits there, and the interest is, it accrues daily with that one. And so if the balance is much lower one day, then you're paying less interest that day. And if it goes up a little bit, then you're going to pay a little higher interest the next couple of days out. But the idea is, of course, like velocity banking, is put all of your eggs in one basket, pay all of your stuff out of that one basket. And then, but because you have some cash flow, you're going to let the money sit there because it's a safe place for it to be, right? And that helps pay down that mortgage as fast as you can. And then it's available to you whenever you need it to throw into the next investment property. And so you find that you can accelerate your pay down so much faster because you have the comfort of knowing that you can get a hold of that money in literally a second. And that's what's so powerful about this loan. I'm very passionate about that because I feel like we need access to capital as investors, and we don't want to necessarily have to run to the bank every time and wait 30 days because we're like, there's our deal. And if I can go in and if we paid down our all-in-one loan really fast and we have, let's say we have all of the money to just go make a cash offer on something, and then we can refinance out of that, put the money back on the HELOC. And now we've got this awesome refinance deal where, again, we're not having to pull all that money up front. Like, it's very, very powerful. You can refinance into this loan. So if you have a conventional and you want an all-in-one, you can refinance into it. We can loan up to $2 million. And again, you can have 3 types of loans. It is typically a lower interest rate than the HELOC at a bank or a credit union, but it is still higher, the interest rate, than it is say, for conventional fixed. It is a variable rate, so it's going to fluctuate. Okay. If you're itemizing your tax deductions, you can use the interest as a write-off still with this particular loan, which HELOCs typically you can't. So that's the other perk. That's really
that is
great.
awesome.
Okay.
That's really cool.
Yeah, right.
That's a perk. That's absolutely a perk you don't get with HELOCs. Yeah.
Yeah. Yeah. We like ways to save money. That's why
Right.
I got into this business. I'm really passionate about not getting screwed.
Yeah.
So I'm always looking for tips and tricks on how not to get screwed.
And most banks are really good at doing it.
Yeah.
Right? So anyway, but let me talk about the cons really quick too while we got a second.
Yeah.
It is not for people who do not have a heavy cash flow. I heard one person talk about it and they said have at least 10% in excess funds typically in any given month on a usual basis. I feel like that's low. I would conservatively say 20%. You want 20 to 30% that you're not going to spend that sits in that bank account that you're saving and waiting for the next opportunity to come along. Okay. So that you're paying that down. And so then it's really like doing the magic. Okay. But now in a conventional loan, you wouldn't want to take an extra, let's say you're able to make an extra $3,000 a month payment every month. You don't really want to do that on a conventional loan because you're tying up your money and then you got to prove to the bank that you qualify in order to get it back out, right? But with this, and you're like, cool, I got an extra $3,000 in cash flow every month. I'm just going to throw out this loan because I know I can pull it out whenever I want, right? But if you're not a person who, if you're living month to month, paycheck to paycheck, this is not the loan for you yet until you're finding that you have that excess cash flow, okay? So let's see here. It does have closing costs and origination fees. So don't think that one, so it's there. But once you have the loan, it's open for 30 years. You have that line of credit open for 30, but here's how it works. After year 10, like on a regular HELOC at year 10, they usually close off and they say, okay, now you're going to pay principal and interest instead of just interest only. And with this loan, they say, okay, at year 10, now we're going to actually just take a nice straight dive down to the 30-year mark. And your HELOC is still open, but it's starting to dwindle as far as the access to capital that you have. And so, if you're getting to the end of your loan, you're like, I don't have access to that much capital. You can refinance and reopen it back up. You know what I mean? But there's just the cost. But you have, let's say a 20-year window where you're not having to pay closing costs and origination fees, and you're able to make the money go in and out and flow. Okay.
That's awesome.
It is a full doc loan though. Even though Fannie Freddie is not, they're not over this loan because it is a portfolio loan. They still go by the standards of Fannie Freddie. So you're still gonna have to prove that you make some income, but you just do that the first year. And then all the years after that, you can do whatever you want, right? So, let's see here. 10 to 15% in reserves. So you do want some reserves a lot. And the DSCR loan also wants reserves, you guys. So make sure you got a little extra money sitting in like an IRA or a bank account, something that you have quick access to your cash, just in case. They do want to see that. 30 days for purchases, 45 days for refinances is how quickly they can fund. And they do not like declining income. So if you're somebody who's made a lot of money in the last 2 years, but now 2023 hit and we're making less, or 2022, and it's showing on your statements and stuff that you're making a little less money, we're gonna have to work that. We're gonna have to work miracles, okay? So declining income, okay. Credit score.
More money.
What's that?
Make more money.
Make more money. Yeah, get out there, get after it. Credit score, got to have at least a 700 for primary. So you can purchase a primary home with this loan, which is where I would start. And 720 to buy an investment property, okay? And the DTI ratios are 43%. So there's your little bit of matrix on that. So
There you go.
yeah, it's a fabulous loan, and I'd love to talk to any of you more about it. It's not very well known in the industry. I only know of 3 other loan officers or 3 other companies in the state that do this. So it's just not very well known. And the reason why is it's not for everybody. It's really for this niche market.
Yeah.
Okay?
And from the perspective of the velocity banking strategy, this affords all of the pros, all of the tools that we need in a line of credit. This gives that to us. Plus, it sounds like some added benefits of a little lower interest rate than your standard HELOC, We get to write off the interest, which you don't get to do in a HELOC because it's not a mortgage, but this sounds like it qualifies as a mortgage. So we get to write off the interest.
That's why it qualifies.
Yeah. So there are some additional cool things that, HELOCs tend to be, at least from my experience and from what I've seen, with my students, they tend to be a little easier to get than a mortgage because they're not subject to, they're not subject to Dodd-Frank. They're not there's no oversight from Fannie and Freddie, like you mentioned. But if you can qualify for this, I think this is the better option than a HELOC. I mean, I think that's awesome. So, Carrie, this is amazing stuff. Thank you so much for sharing this stuff with us. Is there anything that we didn't ask? Oh, we've got a couple of questions in the chat real quick. Sure. So, Tracy asks, what if I have a hard money loan that I need to refi out of? Does the all-in-one apply?
Yes.
So you can refi out of hard money into the all-in-one.
Yeah. So if you can qualify under those stipulations, then yes, you can use it. You can use it as a refi product.
Perfect. Is there anything that we didn't ask that you wanted to share tonight? Take a second if there is and share that, and then we'll open it up to questions and answers.
Yeah. So again, my name is Carrie Mann. I'm a broker at the Lending Co. here in Utah. I'm also licensed in Idaho, just in case you're cluing in now. I, again, love just digging in and I love the puzzle and I love to educate. Those are the two biggest things that I'm attracted to. So if you have any questions or weird things or myself and my team, I have an expert that is my manager that has made me as strong and confident as I am today. And without him, I wouldn't be here. So I owe a lot to that guy too. And he's certainly willing to help out with anybody if I don't know the answers. But that's basically it. I mean, I have a lot to say, but we don't have that much time. So.
No, you're good. That's awesome.
You guys are fantastic. Yeah.
What's the name of your company?
Oh, it's the Lending Co. But I have this other little name that I started,
which I love, by the way. I was gonna brag on it. I love your branding.
Yeah, thank you. Investors are not going to love this name, but it's called Renting Sucks Dog Poop because, it's to help, people that are renting get out of that situation and get into a home. So, because I help all people. So
they can buy our flips too. They'll leave one of our rentals and buy one of our flips, right? So it's all good.
Exactly. Right. Yeah. We're all in this together. And eventually I'll be a person who is a landlord as well. So, but then I'll be excited to help anybody that is in a rental of mine to get out of that and move forward with their lives. So
very cool.
But I started renting too. Everybody does, it seems like, right?
Yeah. Yep. Oh yeah, all of us did. I started renting as well. So I think we've all been there and realized that it does suck dog poop. So we all, we all want to move on to bigger and better things, greener pastures, right?
So you need to follow your channel too. Plug your new TikTok channel because that's hilarious.
Oh, it's Instagram, but yes, I will.
Okay.
So Carrie,
Renting Sucks Dog Poop on Instagram. I would love for you to join me. I just started it like 2 weeks ago, so I have like 50 followers. It's awesome. But I have this really adorable dog, and he likes to be my evil landlord. And and we just have fun. It's a great time. I also have a brochure that I put together. So if anybody's interested in me sharing this brochure, if I quickly share my screen.
Yeah, please do.
You want me to do that? Okay, Hang on just a second. Let me remember how to share it. There it is.
Okay. And anyone can screenshot this too, but then also Carrie can email it to you, I'm sure.
Yes.
Email would be great.
Yes, so I can email it to you. Okay, so
go ahead and start putting your emails in the chat so that Carrie can collect those at the end of the call.
Yeah, so I didn't list everything that you can do. Like I don't have seller financing on here and other ways that Mitch and Maeli they've come up with these amazing ways to do these things. And I even have the one that we talked about where you can become a lender for just a second, that style, that refinance style. But anyway, here are the main ones that are available for investors. So I'd love to share that. Yeah. Just talking about the pros and cons and cool.
And you've got your contact information there at the bottom. Guys, pull out your phones, take a screenshot with your phone if you're on your phone right now, or take a picture of your screen. Make sure that you get that contact information from Carrie so that you can get a hold of you. And then also, we will copy and paste your email addresses from the chat. In fact, Maeli, if you can start taking some snapshots of those that we can forward on to Carrie, so that she'll have your contact information if you would like a copy of this flyer and would like to get more information from Carrie. You can share your information with her. We'll make sure that gets forwarded on.
You know, I am so proud of you two. I shouldn't put it on a pedestal, but I do. Like they say, don't put people on pedestals, but you guys are my heroes, and I love what you guys are doing and that you're sharing your knowledge and your expertise and you're out there and killing it, man. You two are literally some of the coolest people that I know. And I just want to say thank you so much for inviting me to your channel. I'm so honored and very excited to know you and that you guys are my friends and just love you guys. So thank you.
Well, the feeling is mutual, Carrie. We're grateful to have you here, and you know, this is becoming a really neat community of investors that we get to hang out with, not just on a weekly basis on this call, but as friends. I mean, you know, Maeli and Carrie and Eric and I get to hang out on a regular basis, and we have a lot of fun. Masquerade balls at the Capitol, you know, and beyond. So, no, it's a lot of fun. So, now let's open it up to questions. So, guys, do you have any questions for Carrie? She's obviously a wealth of knowledge when it comes to understanding mortgages, whether it's from the consumer side, if you're buying a home for yourself and wanting to move into it, or from the investor side and you're wanting to go out and use traditional financing or some of the creative products that she shared today to go out and start investing in real estate or continue to build your portfolio. What questions do you have for Carrie? The time is yours.
I have a question.
Yeah, Kathy.
Okay, you mentioned this, HELOC that can be a first, but that's basically in the two states that you do. Do you know of a lender or a company or a bank or whatever that can do that out here in North Carolina where I'm at? Because my son is actually looking for that right now as we speak. So we haven't been able to find anyone.
Oh, okay. Well, I'm happy to research and see what I can find for you. The company that I'm talking about, the actual lender on that is CMG Financial, and they're the ones with the all-in-one product. So if you go to CMG Financial, then they can direct you to a loan officer as well. Okay.
Okay. Okay.
The HELOC is the bank. When you do a HELOC through CMG Financial, there are particular banks that pick up these loans, and the banks are out of state. And so, and the other thing that I didn't mention is that your bank account now is your main bank account. And so your banking now will go out of state. So when you get your paychecks, you'll basically have an online bank. So it's not that you'll do in-state banking wherever you are.
Oh, okay. Well, that makes sense.
Yeah, because there's only a couple of banks that specify in doing these types of loans. It's a niche product. Yeah.
Mm-hmm. Okay.
It's a dang cool niche product.
Yeah.
Great question,
Sorry,
Kathy.
My voice sounds terrible.
Any other
today.
questions?
You're cute. You poor thing. We're grateful you're even here.
Yeah, thank
this poor
you.
thing's got strep throat all week, and she shows up anyway. She's the rock star.
That's
like,
Murphy's Law,
honestly.
right? You gotta be a guest on a Zoom call and you get strep throat or get a
Oh my
get a sore
gosh.
throat.
I'll
Yeah.
contact you, Lori. I've got questions about a couple of the different ones. I'm currently trying to refi one, so.
Okay.
I'll set you up, Carrie, with Tracy.
Yeah, absolutely. That's what this call is all about is networking and building relationships and acquiring knowledge. So,
Perfect.
Any other questions?
Well, I have a question. How much did you guys learn something? Yes or no. Did you learn something? Did I bring something new to the table that you
I
haven't
know
heard?
I learned something, so I would hope everybody else learned something as well. I learned some new stuff today, so I'm
Well, and
grateful.
You've been doing this for a long time, so thank you. It means a lot.
Yeah, I've never heard of that all in one loan. I'm really curious about it. And the DSCR loan, so.
Yeah, perfect.
That's a good one.
Both great products.
Also, I think I don't know if you touched base on this, but we've done countless DSR loans in our past, and they also don't make you have too much, like you need so much in reserve, but it's usually like 6 months of like rent. That's pretty cool. Like that's it. You know what I mean? Like you don't have to come up with all this other stuff. It's just like simply like I just need this and check your credit and bam, like you're done. You know what I mean? So that is pretty cool. If people don't know what that is, DSR loans are pretty dope. Like they're great.
Yeah.
So use that. Do that. Do that.
Yeah.
It's true. I love it. Guys, last call for questions. Any questions for Carrie before we wrap this up?
Eric, I know you're out there. What do you got? Just kidding.
I have one question, in case anybody else is thinking about this. You had mentioned about people that want to either refinance or purchase. I've done this in the past. I don't know if you still can, because this was years ago that I was a mortgage broker, but I've had where the seller put in a little bit of concessions, the buyer's agent put in concessions, the selling agent put in concessions, and the loan officer, myself, I've actually put in concessions by upping interest rate so that I can get back in point to help pay for that. Are there banks that still do that nowadays?
I can't speak for everybody else, but we do have the ability to do that, yes. So I typically do it when I need to save a deal, help a client out. So I can do it occasionally. Yeah.
Okay, because I used to do it a lot for investors that were going to flip, and they didn't care what the interest rate was. Well, back then it was, I think, I want to say it was like 6. I would go up as high as 9%, so that everything was covered, and they even got some cash out at the closing. That way they could go and fix their property, and we knew they were going to refinance. And I always told them, I said, please, whatever you do, take 6 months, because it hurts the broker.
Right.
Yes, it does hurt the broker. You're right. Please don't refinance in under 6 months, because really people don't discuss this enough, and I have nothing to hide, but our commission comes out of that first year of interest that you pay.
Correct.
So if somebody goes ahead and refinances, well, then they come to us and they say, we want that commission back, and they literally take it from us.
I didn't know that.
Yeah,
Yep.
So we're on the hook. We're on the hook for up to a year on these mortgages. Agents, they get to just wash their hands, and they're like, but I have to worry about it for a year.
Yeah, you get what's called chargebacks.
Yeah. So.
I didn't know that.
Dang.
Yeah. But as long as, sorry, go ahead. Yeah.
I think that was all
That was
of
a
our
great
questions.
question.
So what were you going to say? As long as what?
I said, sorry. Go ahead.
No, I'm asking what you were going to say.
Oh, I was just saying that was a great question. So good job.
Yeah, absolutely. Thank you, Kathy. All right. So final call for questions. Any last questions? I think we could do one more. Going once, going twice. All right, guys, let's wrap this thing up. Carrie,
Okay,
thank you so much for being here. I'm so grateful, especially since you're struggling with a cough and with a sore throat. Thank you so much for being here. It was an absolute pleasure. We learned so much from you today. So what an awesome value. Guys, we have a couple of announcements. I just want to go over the announcements just one more time before we wrap up the call. Remember that we are now streaming all of these Wednesday calls live on YouTube. You can watch them live. So if you want to interact on the call, you can jump on Zoom, and feel free to ask questions and come off mute and, talk to the guests or talk to me and Maeli as we're going through the different strategies that we go through on a weekly basis. But if you want to just listen or watch and just want to be a passive viewer, you can absolutely hop on the YouTube channel. You'll see it in real time, as well as those videos convert to YouTube videos immediately. So, Kathy, I know you've been asking me when we're going to get these up on YouTube. They now stream live on YouTube and are immediately available for replay on the YouTube channel. That's Flipping with Mitch and Maeli on YouTube. So check that out. And then we talked about the videos, the strategy videos that we've uploaded to the YouTube channel in the last week. You're going to want to check those out. We talked about our live meetings, Tuesday at 1 p.m. in Murray, Utah. Tuesdays at 7 p.m. in Sandy, Utah. And Thursdays at 7 p.m. in Sandy, Utah. All of those are always different topics. So you could attend all three every single week and learn something new in each one of those meetings. And then our all-in event with Mark Kohler, teaching us tax and legal, amazing strategies for business owners and real estate investors. That's going to be in Idaho Falls this coming weekend, or next weekend, excuse me, the 17th and the 18th of February in Idaho Falls. You're going to want to be there. There are a few prerequisites that are required if you're going to attend that meeting. So make sure you reach out to me or Maeli and let's chat. We'd love for you to come along with us. And then we have some awesome stuff coming up. So this week, Carrie Mann shared with us Understanding Mortgages. Next week, we are going to be live dialing. We're going to be smiling and dialing on the call. And this is going to be mostly Maeli because she's the expert at this. But she's going to be smiling and dialing, calling live seller finance leads. So you're not going to want to miss that. That's next Wednesday at 7 p.m. Mountain Time. Guys, I am excited to see you there. And that's all we have for you this week. So go out. Go ahead.
If you have any leads you want me to call on that call, right? Like if you're like, I'm terrified to call, and you're like, Maeli, will you help me? This is a good place to do it. So send me an email and I can help call you for these deals. So this is your chance to have me call your people.
I love it.
Yeah.
Guys, that's all we have for you this week. So in the meantime, until we see you next week, stay healthy, stay safe, stay happy, stay hungry to go out and do some real estate. We love you all, and we'll see you next week. Thank you.